Like it or not, the world runs on oil. And its pricing affects almost everyone in the world, from a Saudi prince worried about the impact on the national treasury, to a shovel operator in Alberta's oil sands worried about his job, to a commuter in Bellingham worried if she can afford to fill her gas tank. So, what does a barrel of oil cost these days? 2 days ago, West Texas Intermediate oil fell 2.7% to $49.81 a barrel, down from more than $100 last June, and well under the break-even threshold analysts say is needed to justify new oil sands expansions. On the same day, Royal Dutch Shell announced that it has scrapped plans for a long-delayed oil sands mine, becoming the latest company to pull the plug on a major Alberta expansion as crude prices hover near multi-year lows. So the price of oil has an impact on economies around the world, especially those of the United States, a major oil producer and consumer, and Canada, whose dollar's value is closely tied to the price of oil. Here in the Pacific Northwest, we're feeling the effects of volatile oil prices. Passenger traffic at Bellingham's International Airport was down 10% in 2014. And will even fewer Canadians use Bellingham International Airport or spend less at the Bellingham Costco and elsewhere now that falling oil prices have helped push the loonie down over 20% since July to 80 cents US. How should governments, businesses, and consumers plan for the future when the price of oil is so volatile? So, to help us sort through these questions and others, we have two expert economists to assist us today. Amar Mann is the chief economist of the Western region of the United States Bureau of Labor Statistics, based in San Francisco. The Bureau, if you don't know, is the chief federal agency responsible for measuring labor market activity, working conditions, and price changes in the economy. Mann has written extensively on economic issues of the West. By the way, if you haven't visited the bls.gov website, you will be astounded at the wealth of information it contains. Ken Peacock is the chief economist and vice president at the Business Council of British Columbia, an association representing approximately 260 large and mid-sized companies that together account for approximately 1/4 of all the jobs in the province. The Council is a collaborative, nonpartisan organization that strives to be a venue where members, policy experts, elected officials, and government decision makers can address problems and form solutions together. Our format today consists of about 15-minute presentations by each of our panelists, followed by questions from me, developed by our program committee, and then questions from our badge-wearing members. That said, please welcome to the City Club Ken Peacock and Amar Mann. And we'll start with Amar.
Okay, thank you so much for that introduction, Chuck. I'm so honored to be here and speaking with you folks today. I saw that Secretary Robert Gates was here a few months ago, and when I told a couple of people I'd be speaking at the same City Club where he spoke, they said, "What the heck are you doing there? You know, why'd they have you there?" But this is definitely in my wheelhouse here to talk about prices, the economy, and oil, and I'll be focusing more on the picture in the United States. Ken can speak more to what's the kind of the Canadian side of that equation. But it's we've seen a very significant decline in oil prices. But what I want to do is talk a little bit about the history with oil production and prices in the U.S. because while it's been very significant, it's not the first time we've seen a steep drop in oil prices. Although it is unusual to see it when we're expanding, when the economy's expanding, we're adding jobs. Typically, you have more demand for oil prices go up. So it's been kind of a different story this time. So first, Chuck, thanks for the plug for BLS. And I will try not to have you guys crank your necks to look at the screen up there. But yeah, as Chuck mentioned, BLS, we put out the monthly jobs number. It's the first Friday of the month, the unemployment rate, the consumer price index, producer price index, information on wages. And a whole host of indicators which are then used by businesses, policymakers, the Federal Reserve Bank, people who are job seekers, career counselors. And so, in many different ways it gets used. It's used to adjust Social Security benefits, the CPI is. So our data gets used by, in one way or another, I think everybody is touched by the data we produce. So some major events. In October of 2013, that's a notable time. Why? Because that was the first time in a really long time that the U.S. produced more petroleum domestically than it imported. So we started to get into this kind of like, people were really excited around this time last year that is kind of entering this halcyon days where we were able to, import less, and gas was getting cheaper, and things were still good. The Canadian dollar was still strong, so you guys were probably not, were pretty happy about that. But it was also symbolic of the reemergence of U.S. petroleum production, because in 1970, the U.S. was the largest producer of oil in the world. And then after that, we experienced a negative supply shock. We didn't have as much supply. And then, some of you may remember throughout the 70s, the long lines, the huge increases in oil prices. And so I want to talk a little bit about that history, but the recent kind of the reemergence of the U.S. as an oil producer was symbolic. And also, so now we also have had these recent price declines. So this is also the next kind of significant notable thing. And there have been some mixed effects, mixed impacts, depending on who you ask. If you ask someone who is working in Texas, or one of the oil men, or someone who's invested in a rig recently, they probably are really unhappy about this. If you ask kind of the average consumer in Middle America, they're probably happy they're spending less money. But there are other winners and losers, and a lot of kinds of impacts that lower oil prices impact a number of things throughout the economy. So I want to kind of paint that picture for you. And so how do we get here? What factors brought us here? What's changed over the last decade from where it just seemed like we would never get any kind of independence in oil? Well, since 2009, our production has drastically increased, in large part due to the enhancements, improvements in shale oil drilling, fracking, as that method has gotten, it's become more feasible, it's become cheaper and more efficient to pull this oil out of shale rocks. And we also have seen our consumption fall. Oil consumption has fallen domestically in the U.S. A few years ago when oil prices were really high, nobody probably, before that, no one would dream of driving a Prius or one of those cars. But then when oil prices were, $4 plus a gallon, then everybody's getting hybrids. And so oil consumption went down. And also, the recession, the Great Recession, had something to do with that as well. Meanwhile, imports also declined during this period. So kind of backing up, the birth of the U.S. oil industry was in 1859 in Titusville, Pennsylvania, where the first oil well was drilled. The boom followed that, and we've had other booms and busts throughout history. I've noted a few here in California in the 1880s. Then you had the kind of the wildcatters in the turn of the century, and also throughout Oklahoma, Louisiana, and East Texas again. So much of the 1900s, here we see a picture from Long Beach in 1926. So much of the 20th century, at least through 1970, a lot of our policies, a lot of our energy went into increasing oil production and really kind of cornering this market for energy. And then that changed after 1970. But if we look back on 1970, the U.S. was producing nearly 10 million barrels a day, which is comparable to the figure that we recently hit. So we're back to producing around that much, although it's dropped a bit recently with the drop in oil prices. And by comparison, Russia was way behind us. You see Saudi Arabia, which is producing a lot more than that today, is producing around 10 million barrels, was at under 4 million, and Venezuela also was a smaller producer. But after 1971, excuse me, we had a kind of a gradual decline in our production here. And meanwhile, Saudi Arabia really just blew up and started to produce a lot of oil and gain dominant market share in that. In '89, daily production fell below 8 million barrels. And, we'll go back. In 1986 is the last time we've kind of seen this where we had a big decline in oil prices while the economy wasn't going through a recession. I mean, in fact, 10 of the last 11 recessions were preceded by an oil shock where prices went up. And so now we're talking about possibly entering a recession because prices have fallen too much. So how does that happen? We'll talk about that. Thanks, Chuck. And yeah, in '75, Russia surpassed the U.S. in production too. So slow decline. And meanwhile, we know our consumption was increasing quite a bit over this period. We were also importing a lot more. Our imports doubled from 1980 to 2005 during that period. And then 2005 to 2007, right before the Great Recession, it's kind of a low point in terms of our oil production. Our consumption, was far greater than our production, and also, we were relying more and more on imports, consuming 21 million barrels a day. Starting in '07, we start to see imports start to decline, dropping by about 4% in 2008, 10% in 2009, and then more and more, 17% between 2011 and 13. And by 2013, our annual imports had fallen to about 3.5 billion barrels a year, which is a 21% decline from 2007. So pretty big decline for such a short period of time. And if you weren't paying attention, it might have been easy to miss that. And this graph here shows the extent of that decline in our imports over that period. So why did we have this decline over the period? Well, a lot of it's 70% of our petroleum usage is in transportation. So gasoline consumption declined quite a bit. We also saw declines in consumption in industrial and residential and commercial applications. And we also had growth in supply going on. So what we see is that, in the past, imports and consumption were starting to kind of converge a little bit. And now, they're diverging. Consumption has kind of leveled off, especially after there was a little bit of a dip during the Great Recession in terms of our consumption. That's leveled off. Meanwhile, our imports have steadily declined. And so domestically, production of oil here has increased by over 47% since '08. And you can kind of see it here, the production over the last 8 years, just the kind of exponential increase. And here we see just in the last 8 years, the red bars are our imports, and blue bars are our domestic production. So you can see that we came even in 2013, and as I mentioned at the end of 2013, we actually were producing more domestically. All right, so where's the production coming from? A number of states, but most notably North Dakota and Texas. And that's where we have the Bakken Shale and the also Eagle Rock in Texas. Those are two of the big ones. The Permian Basin also in West Texas has been a source of a lot of shale oil. And so the rise in our production, we've had a decline in imports. How did it impact our prices? Well, at first, there was really not much impact. So our price of gasoline really didn't change a lot here. We had a lot of demand globally for oil, especially from Asia. And OPEC countries, also many of those, we saw some lower production from those countries. And so there were some global supply shocks as well. People were worried about things popping up in Iran and the Middle East. So while our production and supply was going up quite a bit, our prices didn't really change much, as you would expect. An increase in supply, you'd expect a drop in prices. But because of the increased demand, because of concerns about geopolitical tensions, prices stayed at a fairly high level. And that encouraged more and more drilling to happen in the shale oil states. So yeah, our import prices increased 42% from '09 to '11. Our consumption stayed pretty flat. Imports did fall a bit, and then production domestically increased, but this was just the beginning of far larger increases we'd see after 2011. So why did the prices increase? Supply disruption in Libya, that led to about a 1.3 million barrel per day drop. It's about 2% of global production. Doesn't seem like it'd be a big deal, but it had a big impact, and production was slow to return after that. We also had the ousting of Hosni Mubarak in Egypt, so the whole Arab Spring, that really kind of spooked these markets, oil markets, and also as well as tension with Iran, threats about closing the Strait of Hormuz. So then in 2012, 2013, we start to see prices kind of level off. Global demand weakened, and so we had about a 10% decline in import prices. We also had Canada producing more oil, Russia, OPEC countries, and of course the US with our shale oil, our production and the production in these countries was going up quite a bit. And so finally, we come to where we are today. Okay, so we have 680,000 jobs, people employed in oil and gas production and transportation in this cluster. And the font's way too small on this, but basically, you know, we don't just have a job, the person drilling the well, right? There are many other jobs that are created, not only in the oil fields and supplying equipment and on the pipelines, but also and rail cars, but also, you know, to build shopping centers in these places now where you have a lot of workers and you have settlements, especially in North Dakota. And the blue here, basically, if your state's in blue, it means you're gaining a lot more growth. And we see, you know, especially there's, you know, North Dakota and Texas really jumping out, in New Mexico where you have this shale oil drilling happening. And this here too shows basically indexing to 100. Didn't realize the font was going to be so small. This is about 350. In other words, 3.5 times as much employment in the oil and natural gas industry in North Dakota in 2013 as compared to 2007. So it really was just a huge boom there. Okay, so now coming to more current times. Since June of 2014, we've seen the price of a barrel of oil drop for West Texas Intermediate from around $100 to, I think at the low point it was around 40, and today it's around 50. And for Brent, it's about 60. So what were the causes? A couple of things. Well, there was a supply glut. We had rising inventories. And part of the reason for the supply glut, you know, we were producing more here domestically, but we also had slightly weaker global demand. Although most people would say it was the increase in supply, not the decrease in global demand that caused some of the prices to drop. But in addition to that, OPEC, recently OPEC, they made a decision not to cut production. And so one of the reasons why is to basically, let's say for Saudi Arabia, where it only costs $5 to produce a barrel of oil, if they can push the price down to $40 or $50 and put all these new guys in the US and Russia and Iran and all their other rivals out of business, there's not much incentive to not do that. So they're basically decided not to do cuts. In addition to that, other members of OPEC, you've got Nigeria, Venezuela, Iran, who are really dependent on revenues from oil sales. So if they don't sell the oil at whatever price they can get for it, they're not going to be able to keep their populations happy and run their countries. We've also seen the dollar get stronger. So for us here in the U.S., the stronger dollar has also helped us in terms of making oil cheaper. Our dollar's going further as far as purchasing oil. And finally, some of the geopolitical concerns, Iran, Libya, even Libya with everything, all the turmoil there, they're still pumping out oil. And Ukraine, people are not as, kind of concerned now that that's going to boil over. So these were some of the factors that caused the recent decline we've seen. So there are some good and bad points to this. As I mentioned, for the average consumer, they have more purchasing power. They have more money in their wallet. Some estimates say that it's about $600 million every single day that American consumers have to spend that they did not have if prices were at the June 2014 level. So with the lower prices, basically every single day with prices at the current level, It's translating to around $500 million extra dollars for people to spend, and we know that helps the economy when people are spending money on other things. OPEC, as I mentioned, their objectives have changed too, where they're not really trying to maximize profit and do things to keep oil prices higher. They are trying to maximize their market share, and in the process, as I mentioned, put other folks out of business. We've seen income shifts also. So some of the income shifts from oil exporting nations to oil importing nations. There's been a transfer of income there. As far as, and also, lower inflation. So when oil's cheaper, everything's cheaper. It's less expensive to get goods from point A to point B, less expensive to produce those goods. Okay, so where's the bad? So there's definitely, why are people scared? So this all sounds great to me, right? Our Russians are upset and they're not doing well. Consumers have more money. What's wrong with this? Well, if you're in North Dakota or Texas, and you have a job in this in the shale oil industry, you're probably pretty nervous right now. We've had a lot of rigs shutting down, and also many of these shale oil companies, these independent energy producers, they're highly leveraged. So they actually have to issue junk bonds. So basically, when they're not bringing in, if they're not able to get as much for their oil, it just means their balance sheets are really in bad shape. The junk bonds are really, it's a bigger part of the junk bond market now is these energy producers and shale oil producers. So that's really the concern, is that if these companies go belly up and they're not able to make good on their debts, that it's going to lead to contagion, kind of what we saw with the housing bubble credit crisis in '08. And then, of course, the stronger U.S. dollar, this is one of the things that doesn't get talked about or written about. Janet Yellen testified before Congress yesterday on this issue, and she talked a lot about oil and lower oil prices and how it's helping consumers, and how, we might lose a few jobs in North Dakota and Texas, but she didn't mention, the issue with the energy junk bonds, nor did she mention really, with communities like this one, where you have a lot of consumers coming over from Canada, and with the stronger U.S. dollar, some of the impacts of that. So there's some other, and many other impacts on other fossil fuels and sources of energy as a result of these lower oil prices. So we can talk about all of that. So I'm going to pass it to Ken here in a second. I don't know how I'm doing on time, but we do have, these are some estimates of how much shale oil is in the ground. And when we talk about where are oil prices going to go from here, there's a tremendous amount of shale oil we have that's in the ground. And basically, once the price of a barrel of oil, once it gets above $70 a barrel, it becomes economically feasible to drill for this pretty much everywhere. And so that is going to act as a bit of a ceiling to how high oil prices can go. And it's not only limited to the U.S. So we know oil is a global commodity, and Russia has 75 billion barrels of shale oil that are technically recoverable. China has a very large amount as well, Argentina and Libya. So a lot of implications with this. And also these shale oil drilling rigs, it's not like trying to drill in the North Sea or the ocean floor, where these are really huge projects that take years and huge amounts of infrastructure to pull off. You can have a rig drilling for shale oil at a cost of around $1 million, and they're getting better, faster, cheaper as far as extracting the stuff out of the ground. They're getting better and better at it. So the last thing I'll say is just a thank you to anyone in the room here that has in the past or will in the future participate in one of BLS surveys. The information, a lot of the information I showed, all the information we talk about with the unemployment rate, the jobs number, the CPI, it's all based on voluntary cooperation from businesses. And so if you are asked to participate in the survey, I really hope you do. If not, please call me. I can tell you what's in it for you. And with that, I will share my contact information, and thank you for that time. Look forward to the Q&A. Thanks.
It's great. First of all, thank you to the organizers. But no, it is a great pleasure. I love Bellingham. I'm down here all the time shopping with the kids. That has changed a little bit recently with the dollar. So I mean, hopefully you're enjoying your free aisles in Costco. So a little bit of a different story for Canada. I think Amar hit upon the fact that, on a net basis, overall it's good for the U.S. economy. And at the Business Council, we watch what's going on in the U.S. economy very closely because our members are large companies and they do a lot of trade and a lot of business with the U.S. And when the U.S. does well, British Columbia and the rest of Canada as well. So we do watch it quite closely. Our read is the U.S. economy is coming on quite strongly, and the low oil prices will just reinforce this and make things even better. So that, from our perspective in British Columbia, it's good news. But for the Canadian economy as a whole, the implications of lower oil prices are quite different, and it's a net negative overall. And the main difference there is because the oil sector is so large in Canada, and we export so much of the oil we produce. Canada is the 5th largest oil producer in the globe, so we are very substantial at the global level, and it's the #1 product exported from the Canadian economy, over $100 billion in 2014, and that accounts for almost 20% of everything Canada exports. So when you hit that oil industry, we feel it nationally big time, and Alberta in particular, which I'll get to a little bit more in a moment. Over 500,000 jobs supported by the industry, and then in the Canadian context, Canadian economy, you can use the rule of 10, about a tenth the size of the U.S. economy, so 500,000 jobs, very significant in the Canadian context. By far the #1 source of capital investment and business spending in the country, so that's going to be curtailed sharply. I think in 2014, there were $69 billion spent in the oil and gas industry, and that's poised to fall by about 35%. So a big hit there as well. And of course, government revenue will be hit. Most of the royalties from oil production, well, all the royalties from oil production flow to the province, but because corporate profits are going to be hit so hard, there's going to be fewer people working, there's going to be less corporate income tax and less personal income tax revenue. And as Amar was alluding to, same story in Canada, consumers will benefit significantly. So there is some offset upside from the drop in oil prices, primarily at the pump. Businesses will also see reductions in costs. They won't be more competitive overall because other businesses face the same savings, but I think overall you'll see balance sheets and profits improve because of the drop. Amar touched on the inflation impact with the Bank of Canada, which is the counterpart to the U.S. Federal Reserve up in Canada, is expecting inflation to actually maybe dip into negative territory. But overall, you add it all up, it's a net negative at the national level for the Canadian economy. And indeed, the Bank of Canada, like I said, our counterpart to the U.S. Federal Reserve, revised its forecast. So there's a couple lines there. The one that's straight, that doesn't have the dip, was kind of prior to the sharp fall off in fall from the monetary policy report that the bank does. And then the more recent January outlook, they actually have in 2 quarters of this year economic growth falling by a full percentage point, all attributable to oil. So that's a big, big reduction, and the federal government has postponed putting out its budget because there's so much uncertainty with revenues, and they're trying to figure out exactly what the deficit might be, if they'll be able to balance their books still. So big hit. Private sector forecasts mirror this reduction as well up at the national, federal, or at the federal level. And this is just a quick snapshot. I know you're probably not too interested in Canada fiscal policy, but that is our federal government budgetary balance. And you can see in 2014, 2015, we were down in negative territory at almost $3 billion. But in 2015, 2016, the federal government did plan on balancing the budget and actually turning in a small surplus, but oil prices went south and all that's changed. And this estimate from one of our large banks, the Toronto Dominion Bank, expects that the federal government will now face a $2.3 billion deficit, but over time they will climb out of that hole. So it is having implications for public finances, and they'll have even more substantial implications for public finances in the province of Alberta. And I can't talk about oil prices really without talking about the exchange rate. and they are now completely intertwined. The Canadian dollar is behaving very much like a petrocurrency right now. Usually other factors do play into the Canada-US exchange rate, such as interest rates, such as other commodity prices. Those play into it, economic growth enter into it. But right now, the drop in oil really is taking the Canadian dollar down, weaker vis-a-vis the US dollar, and you can see there about a 20% devaluation in a relatively short period of time. There was a dip in the financial crisis era. Our Canadian dollar did fall, but then it rebounded quite quickly and was back up around parity. It's great for cross-border shoppers. We love the parity world. I love the Bellingham airport. All that was good news. But now we're at 20%, we're facing 20% plus price increases after you do the exchange rate, so you do have fewer shoppers. And as Chuck was saying, fewer people flying out of the Bellingham airport. And you know what? The effect is very real. I talk to people all the time. I used to go down, or I was planning a trip, but now I'm not. In British Columbia, we'll probably benefit from more people traveling up to Canada. Canada's on sale, 20% reduction. Everything you buy in Canada. Come on up. The big thing is a little bit like the United States. The fortunes across the provinces are very, very different. And I mean, poor Alberta next door is reeling. So we got British Columbia, and then we got Alberta, and I'll talk a little bit more about the benefits, the net benefits for British Columbia in a minute. But if you look at that bar there, in 2014, the Alberta economy grew by 4%. Very strong growth in a North American context, not like China, but very strong growth nevertheless. And this year, most recent forecasts from some of the large banks suggest that Alberta will probably slip into recession. So that is a huge turnaround. Same story at the far other end of the country, Newfoundland. We probably don't even ever really think about Newfoundland too much, but it's way over on the East Coast. Gone from small positive growth to a fairly significant recession, 1.3% economic contraction in terms of real GDP. So that is a very substantial turnaround. Rest of the country, not so much. Saskatchewan does produce some oil, but its economy is much more diversified. So provinces like British Columbia and Alberta actually stand to benefit because of the savings to consumers, and also because the weaker dollar is going to help make our products that we export into the U.S. more competitive. So the export sector in provinces like Ontario and provinces like British Columbia will stand to benefit and actually will help boost and lift economic growth. Just some context. Now I'm going to get into a little bit of why it's a net positive for British Columbia. And you can see this is oil production in Canada by the different provinces. And Alberta stands out there. It's almost 70. You add oil sands and traditional oil that you just drill for and extract out of the ground, about 70 million, this is in dollars, $70 million worth of oil produced. And British Columbia, 847 for the entire year. We produce in BC about 20,000 barrels a day, so just teeny. What was your figure? Almost 10 million?
10 million.
Yeah, 10 million. So in context, it's almost irrelevant. The provincial government gets about $100 million in royalties from oil. That's going to fall by about half. They'll get $50 million. They can make that up elsewhere just from stronger economic growth. So not a big impact on British Columbia. And in fact, a significant amount of benefits. We at the Business Council just did a quick estimate and think maybe consumers will save $1 billion for the year if gas prices kind of stay where they are, or perhaps slip a little bit more. That's just based on spending $2,100, maybe $2,300 a year on gasoline. The average household spends that. Maybe we'll see a $550 savings. There's 1.8 million houses in British Columbia. It comes up to pretty close to $1 billion. Businesses will save on transportation costs. Lower fuel prices put downward pressure on inflation. That's good news for consumer. Some of that is offset by the weaker dollar, though, because the weaker dollar means we pay more to import stuff. And we import a lot from the United States. We import from China and other places as well, of course. And we will pay more as a result of the weaker dollar. But on net, I think inflation will be lower because of the weaker Canadian dollar. I touched upon this. Falling oil prices have pushed the dollar down. And again, I touched upon this at the outset, the U.S. economic expansion, our read is absolutely supported by weaker oil prices. So again, that's good news for British Columbia and good news for all of Canada. And I think you're going to see ongoing dampening of cross-border shopping, but you're going to see more Americans traveling in Canada. That does provide a list. The negative or the offset in the British Columbia context is the fact that we do have a whole bunch of people working in the oil sands in Alberta, working in oil production. We have companies in BC supplying inputs into the oil sands and the oil patch in Alberta. So those companies are obviously negatively impacted. We have a whole bunch of families and individuals in that core working age that have packed up and moved to Alberta for high-paying jobs. And when I say high-paying jobs, it's like North Dakota, high-paying jobs, you know, 6 figures plus, and they can't get that kind of money working in Vancouver or British Columbia. So they will be facing layoffs. And in fact, there's some estimates that there are as many as 30,000 people living in BC but working in Alberta. Some of them fly there and work in construction or work in the oil patch. Some of them have contracts and work remotely, but that's a large number in the BC context, and those people will be facing some layoffs or some loss of income as a result of this. The other thing that I will just touch upon, and that may have some effect for suppliers here in locally or even in Washington State, but is the LNG. Is everybody familiar with LNG, if I use the term liquefied natural gas, LNG? Okay, so there's a big press on in British Columbia to attract global energy companies to set up LNG facilities in BC. We got an abundance of gas in the north. Gas prices are weak here in North America, but they're higher in Asia, so there's an arbitrage opportunity there. So you liquefy the gas and you ship it to Asia and you make money, all right? Sounds simple. A lot more complicated than that, unfortunately. The thing about the weak oil prices is LNG prices in Asia are linked to oil. So that's driving down the price, the delivered price for liquefied natural gas over in the Asian markets, and it's creating more uncertainty around these projects. Companies, they're going to be investing 10, 12, $15 billion to build one of these facilities, so they're huge. It would be a very, very substantial lift to the provincial economy, but this whole global energy pricing uncertainty environment is making it more challenging for companies to make long-term investment decisions. It's hitting their balance sheets. They might not have the money to invest, so it's causing these projects to be delayed and pushed back. There is some concern about kind of the window of opportunity closing, and we may not see an LNG facility in British Columbia. We may see a couple. Most people think we'll see a couple, but if we do, it'll be very, very good for BC. That is a potentially very big negative if oil prices stay low and cause these projects to be derailed, but it's uncertain and difficult to say at the moment. That's why, on balance, I say oil prices for BC this year, and if it stays low next year, are a good thing. The sort of absent the LNG factor. And we in Canada, and I guess you probably have it in the States as well, a lot of mobility between the provinces moving back and forth. And a while back, this is the net number moving between BC and Alberta. And we did have more people moving to British Columbia than we had moving to Alberta. So we had a net inflow. What's that year? Back in 2010. And then the oil story got very, very strong, and we had people moving out in fairly large numbers to Alberta, and on a net basis, we were losing 2,500 people each quarter to Alberta. That has since slowed, and now with the move in oil prices and fewer job opportunities, we're back into a net positive. Again, this is somewhat good news for British Columbia because we need these skilled laborers. There's a little bit of a skilled labor shortage, particularly in the construction area in the province, and if we ever did proceed with an LNG project, we really, really need those pipe fitters and welders and other skilled tradespeople that work often in the oil patch in Alberta, and if Alberta's taking them all up, it'll be very difficult to get the projects advanced. So that's a little bit of good news as well. And I'll just show you, not that it's of too much interest to you, but this is our forecast of the Business Council for the BC economy. This year we think it'll grow by about 2.6%. That is about 0.2% higher than we thought a while back because of the drop in oil prices. So we do see it actually having a material impact at the overall macro level. And we expect a little bit stronger growth in 2016, and that is on the expectation that we do see some sort of announcement of an LNG project proceeding and early construction beginning in the latter half of 2016. If that does not come to pass, we would scale back our outlook a little bit. And that, I have a couple slides on the number of visitors coming here. You all know, because you live here, there's fewer Canadians coming down to shop in the Costco and Fred Meyer aisles. That is the number of people, Canadians, coming across the border and returning the same day. I use that as a proxy for cross-border shopping because that's the main reason they're coming down and returning in the same day. And you can see there was a big run-up between 2009, that's right, and that's sort of when the Nexus program really got going and they started counting them better as well, up through 2011, and then it sort of, and the dollar was also gaining ground, so more people were coming. Then it leveled off, and there's a little bit of a reduction there, and if you actually focus in, and what I have there is the monthly numbers for 2013 is the top light blue line, so January, and then the dark blue line is January in 2014. And you can see as we go through 2014 and the Canadian dollar starts to depreciate, you can see the impact on same-day trips into the U.S. And by the time we get into November and December, there's about 50,000 fewer trips each day coming across the border. So if you have noticed that there's fewer BC license plates in the streets, it's real. There's 50,000 fewer in December and maybe even 60 or 70 by the time you get into January. So the impact is real. I know you like your aisles clear, but we're a friendly lot up in Canada. You should probably want to have us back down and spend some money. So that's about it. That's about all I have to say. Bottom line, negative for Canada, positive, mixed across the provinces, but positive for BC because of the consumer spending aspect and the fact businesses save some money, with the caveat that LNG, the uncertainty makes it a little bit more difficult. And then the Canadian currency and the impact on cross-border shopping. Again, some of our retailers who line up on the border, I know some cheese stores and other things that are pretty close to the border, they'll be happy because they were really feeling the impact in the heyday. And you know, just anecdotally, I used to come down and buy gas, and I watched over the past couple of years, there would be people filling up their gas tanks, and then suddenly there was people filling up 2 jerry cans. And then suddenly there was 4 jerry cans behind their car. And I was like, what is going on, people? I didn't think you could do that, but it was real. Now that started to slow down a little bit, but people still save money on gas. The jerry can phenomena, I couldn't believe. Between jerry can and 14 4-liter things of milk, there's a lot of liquid going across the border.
Thank you both. You've given us a lot of information. You've answered a lot of the questions we were thinking of asking. But one we want to ask, currently in our state, there's 19 per week unit trains of oil, 102 car length tanker trains. The question is, if the prices stay where they are, $50 or less than $50 per barrel, what impact do you think that will have on these Bakken oil transportation in our state?
Well, I mean, you know, you're going to have less demand for those tanker cars, obviously, right? So it's it might be good for other industries that will be able to take advantage of those tanker cars. You know, natural gas. We're seeing, for example, in the Bakken Shale that a lot of those rail cars that were filled with oil now, we're seeing more with like natural gas coming out of there. So, you know, not only natural gas, but other, you know, it should, you know, lower the rates to use those cars, increase the availability as well.
Yeah, I mean, it's difficult. I don't have a really good sense of exactly the movement and what's going on, but I think Amar's right. There will be less demand. That might mean fewer shipments, a drop-off in shipments. But at the end of the day, consumption of oil is still going to stay up at a reasonable level. I mean, it's still quite price inelastic, as us economists like to say. So, and you know what? You watch. What's going to happen is, like we were talking about, people are going to buy bigger vehicles because it's cheap, and bigger boats because gas is cheap. And that's going to, over time, work to support demand and lift demand. It may be slow and it may take time, but ultimately that's what will happen. It's just the transition period that's uncertain.
Okay, this next one is maybe even more difficult. If oil prices do not rebound significantly or again stay below $50 a barrel, would it still be cost effective to build a Keystone pipeline to carry Canadian oil sands to the Gulf Coast? Do you have any concept?
Again, that's a corporate decision. Difficult for me to say. I know that in general, there's still a high degree of interest in getting the Keystone Pipeline advanced. And one of the main reasons is that is to open up to other markets, right? I mean, rather than just servicing the U.S. marketplace, because the U.S. is moving more and more towards self-sufficiency. In Canada, we're looking to diversify and get access to other markets. So that's part of the reason and part of the factor. I would suggest there's still a great deal of interest in advancing it. Whether it's totally cost effective or they need oil to be higher, I'm not sure.
No comment?
Yeah,
That's fine.
no comment on that one.
So,
It's a little political right now, so we'll avoid that one.
you touched on this a little bit, but how does the volatility of oil prices impact the domestic production and distribution of other forms of fossil fuels, like coal, natural gas, et cetera?
Yeah, I mean, we've had a tremendous amount of volatility in oil prices. Last month, there were if you look at January, half of the days in the month, we had either a 3% or greater increase in oil prices or a 3% or greater drop. So there's been a lot of volatility. But in terms of for other fuels, lower oil prices, and I think Ken mentioned this as well, lower oil prices, in a lot of cases natural gas prices, they're linked with oil prices, there are contracts. So lower oil prices generally mean lower natural gas prices, in turn lower coal prices. If there's less drilling for oil, well, for example, with the shale oil drilling rigs, those can be deployed to do for natural gas extraction, but then your natural gas prices get even lower, right? So a lot of these these different fossil fuels, they tend to move in the same direction.
Yeah, they do. The only thing I would add to that is I agree that oil and natural gas were quite tightly linked. And then there was the shale gas revolution, 2007, 2008, and the amount of gas in the North American marketplace skyrocketed, and that linkage actually kind of became decoupled. So we had high oil, while we had rock bottom prices for natural gas. Natural gas prices crept up a little bit, and I think now that you're seeing oil prices going down so much, you see downward pressure on natural gas prices again. So there's a little bit of a reconnection there, but the gap is much larger than it once was.
And in certain countries, for example, Germany, where they're importing a lot of their oil through Gazprom in Russia, their natural gas contracts are also linked. So if oil prices drop, their natural gas price drops, and if it goes up, their natural gas price goes up as well.
Yeah.
Okay, thank you. How much volatility in oil prices can we expect? Do you think the price will stabilize or continue to adjust?
Let me look in the crystal ball here. Well, I mean, one thing I mentioned is that once oil prices get above $70 an hour,
I know.
oh yeah, sorry, I forgot. That's what you guys are paying me. No, I'm kidding. No, I'm not kidding. No. The lunch was plenty, Chuck. Don't worry about it. It was a great lunch. I think I'm still digesting it. That's the problem right now. It was excellent. Yeah, once oil prices get above $70 per barrel, then shale oil becomes cost effective pretty much everywhere. Eagle Rock, it's closer to like $45 per barrel. Above that, that's basically the break-even point for that. So, to your point, as far as the volatility, I think the ceiling is lower than we probably thought it was a few years ago. It's getting less expensive to produce shale oil too. A few years ago, it was $70 in the back of shale. It's dropped to $57 is the latest estimate. So people are getting smarter at pulling this stuff out of the ground and getting more of it out as well. So that kind of dampens the ceiling. And as far as the floor, I mean, I mentioned Saudi Arabia, it's costing them $5, right? And it's like the situation with someone who was working in Alberta and or North Dakota, and they're making six figures. And now, well, okay, you're only going to make maybe $30,000 a year or $40,000 a year, but if that's all you can get, you're going to take it. And I think with a lot of these countries in OPEC, they've not shown a willingness to really cut back the production yet. And so in terms of volatility on the upside, I don't see a lot of upside volatility, but that's something that things can change. I mean, a few years ago, if we were to say, "Oh, oil prices are low," everyone would say that's a great thing. But here we are, kind of, a little, we're miserable about it. But except when I fill my tank and it's only, it's cheap. But so that's how I'd respond to that.
You may be miserable. I got a long drive.
Okay.
I'm not miserable.
Yeah.
Okay, well, let me just start. Let's be clear. Nobody foresaw the drop in oil prices, right? So to pretend that we're going to be able to anticipate where it's going to be 6 months from now, no. So if Amar's trying to tell you what his forecast is, no, don't listen to him, because he doesn't.
I'm not forecasting anything. Yeah.
No. In all seriousness, seriously, it really caught most people off guard. I mean, I thought oil prices were going to go lower. I was never a $200 a barrel oil guy. I just didn't believe that was going to play out at all. But nobody. I mean, maybe there's the odd report out there, but no one saw $50 a barrel in this short a time frame. So it's exceedingly difficult to say. I would say having said that, some of the volatility has kind of worked its way out and washed its way out. I don't think you're going to see another 50% price decline in 3 or 4 months. That's probably off the table. But I think you're going to see oil jump around, and if you're a day trader, it's great news.
Great. Thank you. We got a question. Before we ask, or I'll recognize you. Hang on. I'm going here up and out. Okay, we have Jane over here, and Bill is over here. And John is going to ask the first question, and Bill's right behind you if you want to stand.
Thank you. I'm going to put you both on the spot and look into your crystal ball, because I heard the other day that an executive of the Canadian Imperial Bank of Commerce predicted that by 2017, we'd have a 60-cent dollar. I've lived in this region for 30 years, both in BC and Whatcom County. I remember the late 80s and the late 90s when we did have a 60-cent dollar. I'm asking you, do you think we're going to go to a 60-cent dollar by 2017?
That's too low for me. I don't think we're going to go that low. 60 cents. So that's another 20 cents down from roughly where we are now. I do remember the era of 65, 66, 67, and the Canadian dollar did settle in there. In the economic literature, people talk about currencies overshooting what their fair value is. So I think there's definitely more downside risk to the Canadian dollar. But I'd be 73, 74, 75 cents and kind of settling in around there. And I'd be very surprised if it went down to 60 cents.
So Ken, the historic low, was it in the low 70s, as I recall?
Yeah, it was 60, it actually went down to about 62 or 63
really?
cents around 97, 98. And then it's kind of settled in around 65, 66, 67 cents for quite a long time. I went to Disneyland when it was 64 cents, so I remember those days.
Okay, we have a question over here.
Mine is just a quick question. Did you say, or have you stated, what the cost of producing a barrel of tar sands oil is?
I have not, no.
Where's their level?
Yeah, their cost curve, it depends on if they're new projects or older projects. I've heard numbers around $60 a barrel, but those were a few years ago, and I do know that those companies working in the oil sands are working relentlessly at driving out costs. This is what low oil prices, they're driving out costs, and they're having success at doing that. So my sense from that is that their break-even cost is lower than the $60 a barrel. Newer projects, however, are a different story, just because it costs more to bring a new project online. So this is absolutely going to have the effect of dampening investment and slowing down new projects coming online.
Question here.
Thank you. I appreciate this may be beyond the purview of your authority, but what I'm interested in is we've got a couple other problems in this country. Our highways are falling apart, and we have trouble funding highway repair. And most of that money comes from gasoline taxes. And there has been an enormous reluctance, unwillingness, and inability on the part of our legislators to raise gasoline taxes when gasoline prices were high because people complained, oh, it would be inflationary, I couldn't get to work. I'd like to know your comments on that. Wouldn't this be a good time, at least in the US, to raise, and in the state of Washington, to raise the gasoline tax a bit so we could maintain our roads and perhaps fund public transportation better? Thank you.
I mean, carbon taxes have been thrown about for a long time, and I think it's it's up to the policymakers and the politicians to take that step. I mean, it's people. It's no one wants to pass new taxes. I think So I don't know. I'm not really in a position to comment too much on that, but in terms of the carbon tax and climate change, there's sometimes a lot of ideology gets involved in, instead of actually looking at data and, using logic to make the decisions.
Ken, any comment?
I wanted to be invited back. And you're going to put me on the spot and make me answer that question.
You're from Canada. You guys like taxes.
We do. We have a fairly hefty regional transit tax on gasoline, actually, and that's part of the reason people cross the border to shop and buy gas in the States. It's a big factor. You know what? You do hear that argument being made quite frequently, and it's often done in conjunction with carbon taxes. Now is a good time. That's up to you guys whether you're going to vote in favor of that. But I would also note, just in terms of the infrastructure, I indirectly would be supporting what you're saying, but I would come at it from the side of borrowing costs. Boy, borrowing costs are at historic lows. Never have we seen borrowing costs this low. So, I mean, for governments, states, whoever the financing authority may be, it seems to me like a pretty prudent time to take on a little bit of debt at close to zero and build some infrastructure. And there's probably spare capacity in the economy, so it wouldn't be particularly inflationary. So that's the angle I'd come at it from. How you finance it, you could maybe work that out later, but absolutely, this is a theme that you see right around developed countries and some of the international agencies and organizations urging governments with the capacity to take on more debt to do it now, just because it makes an abundance of sense, and put it in things like transportation infrastructure that pay dividends back to productivity and efficiency.
Thank you. We have a question over here. Jane?
Do you think additional motivation for the Saudis to keep oil prices lower is to put more economic pressure on Iran to force them into sort of more conciliatory stance in negotiations about their nuclear program?
Do you want to comment on what the Saudis are thinking?
It's not. I'm not sure about that. The reading I do sometimes suggests they're kind of a little angry at Russia as well, and they're just kind of sticking it to Russia because Russia depends very heavily on revenues from oil, and so I know their fiscal situation is a disaster right now. So, I'll say geopolitics are a big part of what Saudi Arabia is doing. Exactly, the thoughts around some of the specific countries I don't know for sure, but I think it's a factor.
Okay, Bill has a question.
I'm not Bill, but
I
okay.
know, but he is.
Oh, okay. Sorry. Yeah, we travel up in British Columbia and Alberta, and there's a lot of oil, and we see a lot of cows. So there's obviously plenty of milk and plenty of oil in Canada. Is this differential in prices across the border, which is undoubtedly all due to taxes, is that really a good thing for Canada? Or should it be more balanced?
The consumers would like it to be more balanced. The difference in the dairy products comes from the fact we have supply boards. So there's quotas in Canada and restricted supply, and so that keeps the price level higher than it is in the United States. The gasoline differential is more of a tax story than an actual cost of producing a gallon or a liter of gasoline. We got a lot of taxes. We got more taxes layered into our gasoline than you do in the States, particularly in the Lower Mainland. Gas in Alberta is actually quite a bit cheaper than it is in the Lower Mainland region of British Columbia. In BC, we've got gas. There's a provincial road tax. There's a federal road tax. There's a regional called Metro Vancouver, 12 cents a liter, so that's almost 40 cents a gallon, levied on to support transit, and then there's a carbon tax in there as well. And I think PST and GST as well. So there's a lot of taxes layered on a liter of gasoline in Canada.
Okay, question here.
You had touched on the junk bond financing of some of the newer production methods. How big of an issue do you think that is if there's all these companies that go belly up?
Well, the figure I've seen, it's something like, I forget how many hundreds of billions of dollars right now in junk bonds that have, energy bonds that have been issued. And basically it's getting more and more expensive. These bonds, basically the amount of money that they have to pay to just the regular payments on them are really messing up these companies' balance sheets, right? They're bringing in less money. So this is kind of it sort of can remind you a little bit about 2008, a little bit of what we saw when asset prices really were dropping and people were hanging on to these sorts of bonds. I don't think it's nearly as big as that, but it's still it's a significant amount. That's a large part of that market. So no one I think knows really for sure. I mean some folks have at the Federal Reserve Bank have looked at it and they don't think it's too big of a deal.
Bill has a question.
If Keystone doesn't get built, is BC likely to put a pipeline across BC to the West Coast ports?
It's a very good question. That is a challenge. It will be a challenge to get that pipeline built, and that's just because there's a lot of moving pieces. We may. I would not want to say no, but we may. But there's First Nations opposition and other environmental groups that are strongly opposed to it. So it will be very difficult, and some of the communities are also opposed to it. So the companies that do it will have to manage all those issues very, very, very carefully. So likelihood, I don't know, maybe let's say 50-50.
Okay, next question.
This would be a follow-up to that question because there are a couple proposals to bring tar sands oil to the West Coast. I wonder if the most common adjective we hear associated with British Columbia is beautiful. I wonder if the Business Council of British Columbia has calculated both the impacts on tourism to have that additional infrastructure, and has the Business Council of British Columbia done any calculations about the impacts of an oil spill on the pristine waters of British Columbia?
No, we have no calculations. Difficult to value some of those things. My sense is there would be very little impact from actually just having a pipeline in place on tourism because it's buried and out of sight, and maybe there's some pumping stations along the way. But we're talking a vast amount of land in British Columbia. So I don't think there would be any measurable impact on tourism. And I do understand people are afraid of the potential of a spill in the pristine waters on the coast of British Columbia. Difficult to value what that's it. I know that the risk is low, but these events do happen. So that is exactly, you're exactly the sticking point of why people are opposed to it and don't want to see it go ahead. That right there is the risk of a spill.
We have time, I think, for one more question, and it's, you want to stand and maybe use this?
Yeah.
Just talking to
It wasn't too long ago when we said $100 a barrel oil prices, and we're talking about peak oil and economic collapse from that. I assume fracking has pushed that conversation back out a little bit into the future. How far into the future are we going to be having that conversation?
About running out of oil or peak oil, I don't think we're going to have that conversation probably in our lifetimes. I mean, given the amount of shale oil that's out there, the efficiency improvements that are being made, the way that I think a lot of industries in the economy is moving towards less energy intensive. Sure, you got China, you got India, you got countries that are still kind of early on, still going through that development phase that we're past. But I think you look at this shale oil, for example. I mean, there's a ton of it out there. We've got a lot of, then natural gas. You start going through, we still have a lot of coal. So, I don't think we have really to worry about running out of energy. That's not to say that there might not, be other problems and things we've got to be concerned about, externalities that arise from energy use. But in terms of the actual supply, I don't think that's going to be anything we have to worry about for a long time.
He's got it right.
Good for him.
We don't have
Good
to.
for him. So,
Well, and the other thing that was driven a little bit by high oil prices, but it's continuing to happen. I mean, like solar panels, the cost of solar panels is plummeting. So there's other technologies that provide energy and generate that are already coming online. So the combination of an abundance of oil now and some new technologies and cost of alternative technologies continuing to find, I completely agree.
Yeah, I mean, I was reading about this, new technology with batteries that basically during troughs in electricity use, basically these batteries that will, soak up that unused electricity and then, when you have a surge in demand, putting it back out into the grid. So I think, technology has advanced a lot, and there's no reason it won't stop. I think in the last 10 years, even just with what's been done in shale oil has been pretty amazing. I mean, fracking has some environmental impacts, but certainly we're getting to a lot of oil. What's that? Has some? Okay. The understatement of the century. So it's hard to tell what's going to be the impact of all that, absolutely. And you hear there are definitely stories about it ending up in people's drinking water and things like that. So that's a big problem.
before we thank you, we want to, in lieu of the $70 an hour, we'd like to give you a book we call Walking Places 2 for joining us today. So that's